Join us now to take a closer look. Jim Paulsen, author of Paulsen Perspectives on Substack, and former chief investment strategist at Leuthold, and before that, you were Wells Fargo for years and years and years. When was the last time you were on? I'm trying to think of the last time you were on and what you were saying. I think you were...
A couple months ago.
I'm going to tell you what you said back then.
Okay.
Because I
don't know if I remember.
My job, I know. My job, remember. At that point, you still thought we were in the early stages of a secular bull, I think. Yeah. You still think that?
I do, Joe. I do. I think it's been an interesting bull market because of the Fed.
I didn't look that up, by the way. I remember. Yeah, and I don't listen to everybody, so that's a compliment.
Yeah, I appreciate it. We'll see if that works out. You know, this bull market has been such narrow participation, and I think it's because this is the only bull market we've had in post-war history where it's lived under Fed tightening its entire existence.
It's weird.
We've never had that. And the thing I'm a little excited about is we're finally going to change that now, where the Fed's going to finally start to ease. And I think it's going to feel a little bit like the start of a bull when they usually are easing rather than 2 years in. And you know, normally at this point, the Fed would have been easing to come out of the recession and get the bull going. And then 2 years in, we'd be talking about the Fed should tighten now. But we're doing it just backwards. And so I think the bull's going to act differently, too, where you're going to see finally broader participation going on, and probably the mega cap stocks lag, but other parts of the market sort of pick up. Mm-hmm. We finally get full support. We get Fed easing, bond yields decline, money growth is going up. We still got disinflation. And I think the big thing yet is we finally restore confidence a little bit. Another missing element since the pandemic has been just constant pessimism. Yep. And if that picks up, the impact on the stock market historically from rising private sector consumer and business confidence is huge.
You know, in hindsight, you can explain. I think you could explain why the market has done well in a rising interest rate environment, because it was really the Fed trying to slow down an economy that was growing above trend. The inflation, if you think the Fed was raising to counter inflation, you could say that the post-pandemic supply chain inflation, that was going to moderate whether the Fed raised rates either way. So if the reason they were raising was to try to slow down a good economy, the market should go up if there's a good economy. So, I mean, I think Jay Powell, after that initial mistake of staying at zero for too long, really got into a sweet spot on being able to do this.
I think also, Joe, that because he was so tardy, like if you look back historically, this is the only Fed that basically eased while inflation surged all the way to its peak, almost. And then it tightened ever since it's been coming down. You can't find another one like that. But fortunately, all the other economic policies did the opposite. So as the Fed was waiting to tighten, money growth collapsed, bond yields went from 0.5% to 3.5%, fiscal juice went from 18.5% of GDP to 3%, the dollar rose, so there was a lot of tightening that broke inflation. And then once inflation broke, the Fed started tightening, but all those other policies started easing. And I think that's why we're not in recession, because money growth then started to pick up a little bit. Fiscal juice actually has expanded out again. Bond yields have stopped rising up over that period of time. You know, and I think they were offset by some of the other policies.
The only thing that would concern me is that we've already gotten our move in the tightening cycle. There's no reason to get another move in the easing cycle.
I think that there's some truth in that statement, but we're getting aspects, as I said, we've never gotten. We've never lifted confidence yet. I think we're finally going to do it. We're seeing some evidence as we're nearing the Fed easing. We're seeing consumer and small business confidence starting to lift. And that's a big thing that helps the stock market. We've also never really had full-on monetary growth, which we're going to get. And so, and then we still have positive real GDP growth. And I think that there's a couple elements where we've been absent that I think are going to help this market, the broader aspect of it, not necessarily what's been leading, but some of the parts.
It would help if people didn't feel strapped. And wage gains now are able to be real because inflation is down to 2.5%. But the wage gains weren't keeping up with inflation where it was. So people went to the grocery store, said, I can't buy what I bought last
Yeah.
year for the same price. But
Well, you get those surges in inflation. I think it's like that every time. I notice it certainly. You go out and eat, and you go, holy cow, you got to pay, what? But I got to tell you, it also works on the opposite side, where once you start to catch up, your mind starts to catch up with where things are. Because just over the weekend, I filled the tank up. Gas out there is below $3. I had a two-handle on it, and I felt like I was getting cheap gas again for the first time in a long while. So I think we will start to catch up to prices, but I do think that's depressed sentiment. The inflation's pressed sentiment, the tightening, mortgage rates went to 7, a lot of things, and some of that's going to change. And if we get optimism, if you look back where bull markets end, Joe, bull markets do not end when the populist culture is pessimistic. They almost always end on euphoric attitudes, and we are a long ways from that. That's why I think.
Okay.
Even with the Dow hitting new highs, even with Mag 7, some of the amazing advances we've seen for those stocks this year?
Well, it is kind of amazing, Beck. I agree with you. What we're doing on the restoration is pretty amazing. The Mag 7 stocks were 34.5% of S&P market cap in July 10th. They're now like 30.5. We've taken 4 percentage points out of it. And yet, something that was 34% of the market cap of the S&P, we dropped it by 4 percentage points, and the S&P is still on a new high. That tells you that we're correcting this while everything else is going up. And that's a pretty good result so far.